Stop watching the price of Bitcoin. Right now. Stop. Because the price is not the story. The price is the distraction. And while you are watching it, obsessing over every red candle, every correction, every headline about outflows and macro uncertainty, the most significant supply event in Bitcoin's entire history is unfolding in silence. And most retail investors are going to miss it completely. Here is what I need you to understand before we go any further. The next major move in Bitcoin is not going to give you time to react. It is not going to announce itself with a headline. It is not going to wait for you to feel comfortable. It is going to jump. And when it does, the investors who understood what was actually happening beneath the surface will look like geniuses. And the investors who are watching the price and waiting for confirmation will be left asking the same question they always ask. Why didn't I see it coming? I'm going to show you exactly what is coming. And more importantly, I'm going to show you why it's already started. Let me describe what the market looks like right now from the outside. Bitcoin had a brutal correction off its all-time high. It's been struggling. It looks weak. The headlines are full of ETF outflow days, macroeconomic uncertainty, fear, the kind of market environment that makes retail investors question everything. Their conviction, their timing, their entire thesis. This is the illusion, and it is a masterfully engineered one. Because the purpose of this environment, whether it's engineered deliberately or simply the natural mechanics of how markets work, is to make you feel like you're late, like the window is closing, like the smart money already moved and you missed it. It is designed to make you sell, right before the real game begins. Here is the secret that institutional capital understands and retail capital almost never does. The price can stay flat or even look weak while the available supply of Bitcoin disappears entirely. These two things can happen simultaneously, and that disconnect between what the price is doing and what the supply is doing, that gap between perception and reality, that is where the most violent, life-changing market moves are created. While retail is watching weakness, the actual supply of Bitcoin is being systematically cornered, locked away, and removed from the market at a rate we have never witnessed before in this asset's history. Not a theory, a mathematical fact buried in the data. And I am going to show you exactly what that data says. Every Bitcoin that matters for price discovery lives on one of two places. It either sits on an exchange, available, liquid, ready to be sold, or it sits in cold storage, off the market, effectively removed from the tradable supply. Think of exchanges as the world's Bitcoin dealerships. The inventory on the lot, the product available for immediate purchase. Here is what is happening to that inventory right now. The total amount of Bitcoin available to buy on exchanges has plummeted to a multi-year low. The shelves are almost bare. This is not a normal market dynamic. In a healthy, balanced market, you expect exchange supply to fluctuate. Sellers come in, buyers come in, inventory moves around. What you do not expect, what represents a fundamental structural shift, is a sustained, relentless, one-directional drain on available supply that keeps going regardless of what the price does. That is what is happening, and here is why. When a retail investor buys Bitcoin on an exchange, they often leave it there. It stays liquid. It stays in the tradable pool. It can come back to the market anytime. When an institution buys Bitcoin through an ETF, through an OTC desk, through a corporate treasury allocation, that Bitcoin does not stay liquid. It goes into cold storage. It gets locked away to back a security filed with the SEC. It becomes foundational. It does not come back. The supply pool is shrinking, and the buyers replacing the sellers are the kind of buyers who never sell. Let me show you exactly how this removal mechanism works, because this is the part most retail investors don't fully understand about spot ETFs. When you buy a share of BlackRock's IBIT or Fidelity's FBTC, you are not buying Bitcoin directly. You are buying a share of a fund. But here is the critical mechanism. When that fund receives your money, it goes out into the market and buys real Bitcoin, physical Bitcoin, and it takes that Bitcoin off the market and locks it in cold storage to back your share. That Bitcoin is gone from the tradable supply, permanently, for as long as you hold that share. Since the US spot Bitcoin ETFs launched, cumulative net inflows have exceeded $56 billion. $56 billion of institutional capital flowing into a mechanism that permanently removes Bitcoin from the available supply. Now, I know what some of you are thinking. What about the outflow days? What about the days when the ETFs show net redemptions? Doesn't that mean the thesis is broken? No, and here's why. Those outflow days are normal profit-taking market noise. They are a single wave in a rising tide. The question is not whether individual waves go backward. The question is where the tide is moving, and the tide, of $56 billion worth of institutional allocation, is moving in one direction. More importantly, look at what has changed in how the market handles Bitcoin dips. The deep, multi-week corrections that used to shake retail investors out of their positions are now being met by the largest asset managers in the world, treating them as strategic buying opportunities. The behavior of the market itself has fundamentally changed. But here is where the supply story gets even more dangerous for retail investors who aren't watching the right signals. The ETF flows you can see, the daily inflow and outflow numbers Bloomberg reports, those are not the whole picture. They are not even close to the whole picture. There is a much larger, quieter accumulation happening completely out of public view. Over 148 publicly listed companies now hold Bitcoin on their balance sheets as a primary treasury reserve asset. Not a speculative position, not a trade, a treasury reserve. The same way a corporation holds cash or gold. And then there are the OTC desks. When an institution or a sovereign wealth fund wants to buy $500 million worth of Bitcoin without moving the market, they don't go to an exchange. They go to private over-the-counter brokers who source large blocks of Bitcoin quietly, away from the public order book. These transactions are largely invisible. They don't show up in exchange data. They don't move the price in real time. They don't trigger any headline. They just silently drain the available supply. While the retail market is arguing about a 5% price correction, debating on Reddit whether we're entering a bear market or a bull trap, the titans of global finance are quietly draining the ocean itself. The price you see on your screen is a lie of omission. It reflects the noise, not the signal. If you just found this channel, what you're watching is institutional grade crypto research for retail investors who refuse to be left behind. This is the smart money ecosystem. Subscribe right now, because what I'm about to show you next, the collision that happens when an unstoppable force meets an immovable object, is where this entire thesis converges into a single, inevitable conclusion. Let me show you both sides of the collision that is building right now. On one side, the unstoppable force. The wall of institutional money that has decided Bitcoin is a legitimate strategic asset is not a trend. It is a seismic shift in the architecture of global finance. Bitcoin is no longer being framed by institutional capital as a speculative technology bet. It is being framed as digital property, as a global neutral reserve asset, as the hardest form of money ever created. And the institutions managing the trillions of dollars that are now beginning to allocate to that thesis, they are in the pregame show. Not the first inning, not the third quarter, the pregame show. The sovereign wealth funds, the pension funds, the endowments, the insurance companies. These are institutions that measure allocation timelines in decades, not months. When they start moving, and they are starting to move, the capital involved is not comparable to anything the retail crypto market has ever absorbed. This is the unstoppable force. On the other side, the immovable object. Bitcoin's fixed, unchangeable supply. In every other market, when demand surges, supply responds. Oil price spikes. Producers drill more wells. Gold price spikes. Miners work overtime. Commodity markets self-correct because supply can expand to meet demand. Bitcoin breaks this fundamental law of economics. Its creation is fixed by immutable code. No human decision, no board meeting, no government order can change it. And in 2024, the halving permanently slashed the creation of new Bitcoin in half to just 450 Bitcoin per day. 450 Bitcoin for the entire planet every day. Now let me show you what happens when you put the unstoppable force against that number. In January 2026, institutional buyers, ETFs, corporate treasuries, OTC accumulation, absorbed 81,200 Bitcoin. Miners produced 13,500 Bitcoin. Institutional demand was 6 times the entire monthly supply. 6 times. This is not a balanced market. This is not a bull market. This is a structural deficit. And a structural deficit has a specific mathematically predictable outcome. It just doesn't always have a predictable timeline. I want to be precise about what the term structural deficit means, because it is the most important concept in this entire video. A structural deficit is not a temporary supply shortage. It is not a headline event. It is a condition where demand is systemically, permanently, and mathematically guaranteed to outstrip available supply. Not for a day, not for a week, but as a sustained market reality. When a market enters a structural deficit, normal pricing behavior breaks down completely. In a normal market, price rises gradually as demand increases. Supply adjusts. The market finds equilibrium. Buyers and sellers negotiate the price upward in an orderly fashion. In a structural deficit, when the available supply isn't just scarce, but actively disappearing, the market doesn't move gradually. It reprices in violent, discontinuous leaps. Because what you lose in a structural deficit isn't just price, it's availability. And availability can disappear overnight. You cannot negotiate with a market that has no sellers. You cannot dollar cost average your way into a position that no longer exists. When supply disappears, time disappears with it. The most dangerous psychological trap in this environment is the belief that you will have time, the belief that you will see a confirmation signal, read a headline, feel comfortable, and then act. That is a fatal misunderstanding of how supply shocks work. Supply shocks don't give you confirmation, they remove your opportunity. There is one more piece of this that most retail investors miss entirely. Even the existing supply of Bitcoin that hasn't been absorbed by institutions, the coins that are still technically in circulation, a record-breaking percentage of that supply hasn't moved in over a year. These are the earliest adopters, the strongest believers, the wallets that have already survived multiple 80% corrections and didn't flinch. These are not weak hands. These coins are not for sale at these prices. And the owners of these coins have already proven that. Through every bear market, every FUD cycle, every moment the mainstream declared Bitcoin dead, they didn't sell. They are not going to sell now. Not at $1.40 relative to where they bought. Which brings me to the most important rule in all of Bitcoin market dynamics. Bitcoin doesn't go up when new buyers arrive. Bitcoin goes up when the sellers disappear. And the sellers, the ones still left, are disappearing fast. Here is the analogy I want you to carry with you after this video. Imagine a game of musical chairs. It's the game you know, people walking in a circle, music playing, one chair fewer than players. When the music stops, someone is left standing. Now imagine that game with one critical difference. Thousands of new players just walked into the room. Deep-pocketed institutional players who are not going anywhere. And instead of adding chairs, the game master is removing them. Every round, permanently. The music is still playing. People are still walking calmly in a circle. It looks orderly, it looks fine. But the number of chairs is collapsing. The number of players is exploding. And when the music stops, it doesn't stop gradually. It stops instantly. The retail investors who are standing on the outside of the room, waiting to see what happens, waiting for confirmation, waiting to feel comfortable, they don't get a chair. The chairs go to the people already in the circle, the window is still open, the music is still playing, but the chairs are disappearing faster than most retail investors realize. And the moment that changes, it will change without warning. Let me leave you with exactly where we stand right now. Exchange supply at multi-year lows and falling. Over $56 billion in spot ETF inflows, locking Bitcoin into cold storage permanently. 148 plus public companies holding Bitcoin as a treasury reserve. Sovereign wealth funds and pension funds beginning their allocation cycle. Miners producing 450 Bitcoin per day against institutional demand running at 6 times that rate, and a record percentage of existing supply held by long-term holders who have already proven they are not sellers. This is the great supply shock, and it has already begun. The price doesn't reflect it yet. That is not a contradiction. That is the opportunity. Because the price always catches up to the supply. Always, without exception. The only question is whether you are positioned when it does, or whether you are watching from the outside, asking yourself why you didn't see it coming. This is Crypto Corner with Steve. This is the smart money ecosystem. If this research opened your eyes to what most retail investors are completely missing right now, subscribe. Share this with someone who needs to see it, and I'll see you in the next one.